But does it mean there is a bit of a complacency factor which is coming into the market and this over-exuberance is getting overdone? We'll pose that question to Amit Jeswani from Stallion Asset Management joining us on the show. Amit, hi. Good to have you and good to be speaking with you. That's exactly my first question. This kind of listing gains that we are seeing, the kind of subscription figures, the kind of big moves in the small and mid-cap space, is it leading you to believe that there's a bit of a complacency factor or an over-exuberance at play?
You do get scared sometimes. So good afternoon, Anisha. Good afternoon, everyone. And so nice to speak to you, Anisha, today. Anisha, yes, you do sometimes feel scared that the markets, especially the small cap space, probably might have overrun. But markets broadly are chasing earnings, and be it small cap, large caps, wherever you see earnings, the markets are chasing them. Be it pipe companies, be it capital marketplace. The markets are very clear that they want to chase earnings, and we have to write this. In a bull market, it's very tough to hold on to your winners. And so in the stock market make three decisions. Buying is a decision, selling is a decision, and doing nothing is also a decision. The toughest decision in a roaring bull market is holding on to your winners. That's what we are trying to do, and we have to be impatient. If we you cannot say that, oh, stock will stay here for 6 months and I will not do anything because capital is limited, opportunities are large, then you need to make it very, very, very large. But we also believe that the markets are not as cheap. It's very tough to find good ideas. That's the only thing. But anyone who's invested in this market, regardless of market cycles, for next 5-10 years, and if you are smart enough, you'll do very, very, very well. This 5% up and down, I can't time, of course, but next decade looks very, very, very promising, and it's the time to change your net worth, not just like 5-10% here and there. Yeah.
Okay, so not looking at chasing that 5-10% because it's the decade-long story that you need to play out, and if you play it smart, you can make big bucks in the Indian markets right now. But you know, one sector which has made the comeback this year has been the public sector names, right? Whether it's defense, whether it's industrials, power financiers for that instance, and then of course now the rest of the space is also perking up, whether oil and gas, etc. Do you think the rally is behind?
So I don't know if the rally is behind or not. Actually, we have zero exposure there. So unfortunately, if you ask me, it will be, in Hindi we say khatte angur or something like that. So for us, it's been very, sour grapes. And it's been a ride where we had no framework which could have predicted these kind of moves in the public sector banks, and we've completely missed out. I don't think we would have bought public sector bank, but railways. See, railways have been in the markets for now about 19 years, and railways, every budget, they would go higher and then they would come down. The railway stocks, Titagar, etc. And it's not like this time someone asked me, why did you not buy railways? Vande Bharat was such an easy story. But so was Garib Yatra, so was Jan Shatabdi, so was so many new train Tejas, etc. How would I come to know that this India, this new Vande Bharat is the point at which we go ahead and buy? So these are very tough frameworks to get into. And we at Stallion look at repeatable patterns. We had no pattern which could have said that you'll see 5-10x gains. It's some problem in us, not in the market. The markets are right, we're wrong. But even without PSUs, the portfolios have done decently well. Like, we are very happy with the returns, at least this year.
Yeah, and I think it's only that hindsight that makes us wiser, right? And you're not alone. A lot of us, and including the viewers, are in that Angur Khatte Hai category. But you know, what about the banking sector? Do you think that is one area which is providing value right now? Because it hasn't run up. In terms of credit growth, it's strong. The asset quality is not an issue. And RBI has been ahead of the curve in monitoring all of that.
Anisha, actually, banks have underperformed very heavily this bull market. And that is because the growth rates have come down. In India, today, if your nominal GDP growth is 14%, you want to bet on companies which are growing at 30%, 25%, and accept a Bajaj Finance, a 5-star, or 1-2 more names, Equitas. We may have vested interest. These are not recommendations. Whatever I speak, I may have vested interest. Me, my family, our clients would all have vested interest. So these are not recommendations, of course. But coming back, Market wants growth. There was a time between 2013 and 2020 where Nifty EPS growth used to be 3, 4, 5%. And banks would grow at 20%. That was a time where big money got made in banks. Today, you get 20% growth in so many stocks that why would someone buy for a 15, 18% growth leverage businesses? And also the fact that FIs are the biggest buyers of banks, which have been missing in the market. On our portfolio level, we've cut banks allocation to 15%. In this bull market, we want to make it large. So we've just cut like 15%. HDFC Bank pro forma growth is 15%. We don't have any exposure there. We in fact cut last quarter, we cut a lot of exposure towards banks and bought some capital market stocks like MCX and Angel. And they did so well. So we have no regret selling these banks. You have to look at relative opportunities. And we may get back to banks if they start growing. But for today, our lending portfolio is very low. It's like probably 13, 14% of our portfolio lenders.
Point actually, you have to look at the relative comparison there, but a bit of a contrarian view, I should say, Amit, because for rest of the market there seems to be a consensus buy of sorts on the banking names despite the underperformance. But then where are you putting in money apart from industrials that you pointed out? Which are the other areas, interesting sectors or stocks that you have looked at positively recently?
So Nisha, last quarter we added this name called Nuvama in our portfolio. So Nuvama's Edelweiss, it just got listed. It's the wealth management business, asset management business, and the custody business of wealth management. And we expect profits of 550 crores this year. And the market cap is around 11,000 crores today. So it's at 20p. If you look at Anand Rathi, it's at superior business, Anand Rathi, but it's at 50p. Wealth Managers is a cash machine business and they're growing at 30%. Nuvama is, of course, owned by PAG. So if you're getting in capital markets, so our allocation is not very large, but in Nuvama, it's 3%, 2.5%, 3% of our portfolio. But these are the kind of bets that you need to look out for, which are demergers. These are times to go back to, because it's very tough to find new ideas in the market where you're going to double, triple your money. It's very tough. So you'll have to go back to saying that, you know what, I don't want to take too much downside risk. And wherever I can get alpha opportunities, I'll go for it. So this quarter, we've added Nuvama. Last quarter, we added MCX and Angel, which has done very, very, very well for us. So capital markets is about 15% of our portfolio. We reduced financials. Financials is high beta. So we've reduced financials and we bought capital market, which is also high beta. Because if you're buying a high beta, you have to reduce high beta from your portfolio. You cannot. So that is what we've done. And consumer. Anisha, in a consumer, if you look at this quarter, it's very simple, you know, like Trent grew at 60%, Shoppers Stop grew at 2%, V-Mart growth was negative. You need to be with players who are gaining market share, scaling at, say, 60% growth we've never seen in our life in a consumer. Even D-Mart we had in our portfolio, we would never see 60% growth. So wherever you're seeing very high growth, like Zomato, Zomato looks like should grow at 50%. We've added some more Zomato this quarter. In our portfolio, we have to give gifts. A person is performing so where Blinkit is scaling at 25-30% quarter over quarter. At today, Blinkit is at 2,800 crore GMV this quarter. Blinkit itself, I think, will become a 20,000 crore GMV business. And Zomato can be a very large bet for investors. Like even today, I think it's a reasonable bet. Like we expect, and we are always dreamers, always optimistic. And we have estimate 2,000 crores PAT for Zomato next year, like in FY25. And if we go right, hopefully, we should make decent returns. Anisha, we have to dream big. The best performing fund manager has been Peter Lynch. For 14 years, he did 29.8% compounding, if I'm not wrong. I've seen Mark Miravni doing 220% compounding for 5 years. That is public data for. So we have to dream big in this bull market. In the next 10 years, we have to make it very large. And you need the right kind of entrepreneurs and right kind of businesses that you want to hold and you want to buy them at decent prices, hold them till they're growing okay. And when you get other opportunity, you move. We will churn the portfolios, but we need we have to make it. If we don't make it large this decade, we've missed out on very large opportunity.
Quite motivational to say. You can't miss out this rally in this decade which is there for India. It's your loss if you miss it. But I'll wrap up the conversation by asking you, Amit, do you have a FOMO when it comes to at least the real estate pack? Is there any the grapes are feeling there? Even real estate, the premiumization trend and the rest of the urban consumption, apart from Zomato?
No, so we did play new tech very well. We created about 14-15% alphas in new tech in this year. So we've done well on new tech. On real estate, it is out of our frameworks again. But when the entire sector is making a new high, I'm sure 1 year from today, I probably will come to your channel and say that grapes were sour. So, but I'm not eating those grapes right now. My companies are also growing at 30-40%. So I have no problem if, someone is getting richer faster than me. It's just that I should also get richer. So we're doing okay. Real estate, very tough to understand. Whenever we buy real estate, the problem is whenever a 20% dip comes or a 30% dip comes or some macro event happens, you don't come to know, should I buy more or should I sell it? Because these real estate are mostly cyclicals. Now that I'm not buying it, it'll probably become a secular story. But mostly they're very cyclical, and we have no exposure towards real estate. We missed out on Phoenix Mills. That is one play that we wanted to own in our portfolio, but that was the only play that But we have so many other building material plays. We have wires and cables in our portfolio, which has done very well. It has given me 6x, 7x. In 4 years, which is not bad. There are so many other companies which are growing at 30% that we say that we cannot play everything. And markets is like a buffet today. Today you see from financials to consumer to pharma to pipe companies to steel, you're getting alphas everywhere. So, and money is also limited, to be honest. Even new tech, you can get very large alphas. All these guys will be profitable next year. So let's see how we perform, Anisha, next year. It is very important that we make it large next year. And we also have to control our risk. It's not like risk is not important. Sorry, I'm overstretching my answer. But you have to see, you've got markets are typically volatile when political risk is there. But FIs have been sellers. Out of last 7 years, FIs have been buyer for 1 year. When FIs come back, a new growth stock, a new story will get created, and stocks can rally multiple times. Look at growth. Look at companies who can do 30-40% growth. That's where big money can be made.
Well, yes, on that optimistic note, we'll let you go, Amit. Appreciate talking with you. And that's the right point that you're making, which is a bit heartening because a lot of us face that dilemma. When the stocks do go down, do you buy them? Especially the stocks like real estate and those cycles. So appreciate you having a candid chat with us.